Have you ever wondered how to calculate your ROI without any documentation? Well, you might think it's impossible, but that's a mistake. In today's video, I'm going to reveal how you can accurately assess your rental property profitably, even if you don't have all the paperwork at hand. This is going to be crucial for every real estate investor, especially in dynamic markets like Oahu, Hawaii, or Dallas, Texas. Stick around because this is something that you don't want to miss. Understanding your rental property's ROI is essential. It allows you to make an informed decision, optimize your investment, and ultimately increase your profitability. But if you don't have all the documentation, perhaps you're looking at a potential investment and the seller isn't, forthcoming with all the details. Or maybe you've misplaced some crucial records. Whatever the case may be, this video will kind of empower you to kind of move forward confidently, ensuring you never miss out on a great deal due to any missing paperwork. Knowing your ROI helps you gauge the success of your investment. It allows you to compare your different properties, decide whether to allocate your funds, and identify which investments are worth holding on to and which ones you might consider selling. ROI is not just a number, it's a key performance indicator that can guide your entire investment strategy. Without this knowledge, you might find yourself in less profitable ventures, potentially losing money and time. To calculate it without any documentation, this will help you sharpen your analytical skills. It forces you to dig deeper into your market data, make educated estimates, and rely on your understanding of the market rather than just the numbers on paper. This can make you a more versatile and resilient investor, capable of navigating various challenges in the real estate market. It's a valuable skill that sets you apart from those who solely just really available documentation that they have. Finally, this approach ensures you remain proactive and prepared in real estate. Opportunities can arise unexpectedly, and being able to quickly and accurately assess a property's potential ROI can give you a competitive edge. Whether you're attending an auction, dealing with a reluctant seller, or evaluating a sudden market shift, these skills allow you to act decisively and confidently. All right, let's go over the steps. So step one, utilizing your market data. You must calculate your ROI without documentation to gather comprehensive market data. Market data is crucial as it gives you a snapshot of the economic environment and property trends in the area. This includes average rental rates, the vacancy rates, comparable property sales. Websites like Zillow, Realtor.com, and local MLS listings are valuable resources. By understanding the local market dynamics, you can estimate potential rental income and property value with reasonable accuracy. This method relies heavily on available public data and trends, making it a powerful tool for any investor. In markets like Oahu, Hawaii, or Dallas, Texas, understanding your local dynamics can make a significant difference. For example, Oahu has a unique real estate market driven by its status as a prime tourist destination. This often results in a higher rental rate, but also higher vacancy rates due to the seasonal nature of the tourism. On the other hand, Dallas offers a more stable rental market with steadily demand driven by job growth and robust economy. This stability can be practically attractive for long-term investors looking for a consistent return. Using platforms like Zillow, you can analyze the historical rental prices and trends to estimate your current and future rental income. Look at similar properties in those areas, focusing on those with comparable size, amenities, and location. Additionally, reviewing recent property sales can provide insight into the property's current market value. Combining this data gives you a clear picture of the potential rental income and the property value, even without the detailed documentation. Don't forget to check your local vacancy rates, which can significantly impact your rental income. High vacancy rates might indicate a saturated market or low demand, which can affect your ROI. On the other hand, low vacancy rates suggest strong demand and can boost your rental income. Understanding these nuances can help you make your more informed decisions and better estimate your potential returns. Moreover, your local economic indicators such as employment rates and new business developments can provide additional context to your market analysis. Additionally, consider consulting your local area real estate agents and property managers who can provide the insider knowledge and trends that might be able to immediately apparent through online data. They can offer insights on upcoming developments, changes in zoning laws, and other factors that could impact property values and rental rates. Engaging with your local professionals can enhance your understanding of the market and improve your ROI calculations. Furthermore, considering utilizing the real estate investment software and tools that offer advanced analytics and predictive modeling, these tools can help you analyze large data sets, identify trends, and forecast your future market conditions. Leveraging the technology in your market analysis can give you a competitive edge, and it can help you make that data-driven investment decision. Okay, moving on to our step 2, estimate your operating expenses. Next, you need to estimate the operating expenses. This includes property management fees, your maintenance costs, your property taxes, your insurance, and utilities. Operating expenses are essentially to consider because they directly impact your net operating income, which in turn affects your ROI. You can find average expense ratios online and consult with your local property managers to get a ballpark figure of many property management companies. Real estate websites provide you useful benchmarks for these expenses. Property management fees typically range from 8% to 12% of the monthly rental income. In a market like Oahu, where property values and rents are higher, you might find slightly higher management fees compared to Dallas, where the cost of living and property values are lower. Maintenance costs can also vary widely depending on the property's age and location and condition. Newer properties might have a lower maintenance cost initially, but older properties may require more frequent repairs and updates. Property taxes and insurance are other significant expenses. In Dallas, property taxes tend to be higher than the national average, which can impact your overall expenses. Hawaii's insurance costs might be higher due to the risk associated with the natural disasters like hurricanes and floods. It's essential to account for those regional differences when estimating your expenses. Utilities, although often paid by tenants, might still have occasional costs for landlord, especially if the property is vacant or includes communal areas. Consult with your local property managers can provide more accurate estimates tailored to your specific market. They have firsthand knowledge of typical expenses and can offer that valuable insight. They can help you understand any hidden costs that might not be immediately apparent but can affect your ROI. Be accurately estimate these expenses, you can better assess your property's profitability and make better informed decisions. Another critical aspect of your estimated operating expenses is considering the potential vacancies and tenant turnover. These factors can significantly impact your overall profitability, and high turnover rate that might lead to additional costs for advertising, cleaning, preparing the unit for new tenants. In contrast, long-term tenants can provide stable rental income and reduce the higher expense. Understanding tenant behavior and preferences in your market can help you anticipate these costs and factor them into your ROI calculations. So additionally, it's essential to budget for unexpected expenses and repairs. Even with thorough inspections and regular maintenance, unexpected issues will arise, such as plumbing problems, electrical issues, or natural disasters. Setting aside a contingency fund can help you manage these unexpected costs without significant impact in your ROI. This proactive approach ensures that you are prepared for any eventualities and can maintain the profitability of your investment. Effective expense management goes beyond just estimating costs. It involves implementing strategies to minimize and optimize these expenses. Regular review of your operating expenses can identify areas where you can cut costs without compromising property's value or tenant satisfaction. For instance, energy-efficient upgrades can reduce utilities costs and appeal to the environmental conscience of the tenants. Explore the bulk purchasing options for maintenance supplies and negotiate better rates with your contractors and your service providers. Build strong relationships with your reliable vendors. That can result in some cost savings and ensure your high-quality work. Additionally, considering implementing preventive maintenance programs to address potential issues before they become that major problem. Saving you money at the end of the day, pretty much on the long run. Another essential aspect of expense management is understanding the tax implications of your investments. Familiarize yourself with your local tax laws and your potential deductions for rental properties. Work with a knowledgeable accountant or tax advisor to ensure you're maximizing your tax benefits and reducing those overall expenses. Tax planning can significantly impact your NOI and consequently your ROI. Insurance is another area of your strategic management can lead to cost savings. Regularly review your insurance policies. and shop around for better rates. Ensure you have adequate coverage for potential risk while avoiding unnecessary or redundant policies. This balance helps you protect your investment while keeping insurance costs manageable. So now let's look at how you're going to calculate your net operating income and your ROI. Once you have your estimated income and your expense, calculate your net operating income, subtract your estimated expenses from your estimated rental income. The formula is straightforward but crucial. NOI equals total rental income minus your operating expense. The NOI provides a clear picture of the property's profitability before financing and taxes. It's an essential metric for any real estate investor as it directly impacts your return on your investment. After determining your NOI, the next step is calculating your ROI. The ROI formula is ROI equals NOI over your property value by 100. This will give you a percentage that represents your annual return on investment. For example, if your estimated NOI is $20,000 and your property value is $200,000, your ROI would be 10%. So 10% of ROI is considered pretty good for real estate market, indicating a strong investment at normal right now. However, it's essential to compare that ROI with other potential investments to ensure you're making the best decision. In markets like here in Hawaii or Dallas, where property values and rental rates can vary significantly, this calculation helps you identify the best opportunity. So when you calculate your ROI without your full documentation, it can be challenging, but feasibly with the right approach and tools, it can be good. By leveraging your market data, estimating operating expenses, you're accurately and understanding your local market dynamics, you can make an informed investment decision. This approach ensures you're not missing out on potential lucrative investments due to a lack of paperwork. This method of calculating ROI can be beneficial during negotiations. If you can demonstrate a thorough understanding of the property's potential profitability, even without the full documentation, it can strengthen your position and your possible security at better terms. Sellers and other stakeholders are likely to respect your diligence and your confidence, which can lead to more favorable outcomes in your investment endeavors. Always remember, continuously monitor and update your ROI calculations as new information becomes available. Real estate markets are dynamic, and factors such as economic changes, new developments, and shifts in tenants preferences can impact your initial estimates. Regularly reviewing your calculations ensures that you remain informed and can adapt your investment strategy as needed, and that's very important. This proactive approach helps you stay ahead in the competitive real estate market. You gotta be flexible. When calculating your ROI, it's crucial to consider both short-term and long-term perspectives. While the annual ROI provides a snapshot of your investment current performance, long-term ROI considers appreciation, mortgage paydown, and potential tax benefits. Understanding the difference in the different dimensions can give you a more comprehensive view of your investment overall profitability. So appreciation is a key factor as well in the long-term ROI. Research historically appreciation rates in your market and consider factors that might influence future appreciation, such as economic growth, the population trends, infrastructure and developments. Properties in high demand areas with limited supply tend to appreciate faster. Enhancing your long-term ROI, mortgage paydown is another important consideration. As you pay down your mortgage, your equity in the property increases, which can boost your overall ROI. Factor in the principal reduction and consider strategies to accelerate the mortgage paydown, such as making an additional payment on your refinancing to a shorter loan term. This approach can improve your equity position and increase your property's profitability. Potential tax benefits such as depreciation can also impact your long-term ROI. Depreciation allows you to deduct a portion of your property's value each year, reducing your taxable income. Work with a tax advisor to ensure that you're taking full advantage of available tax benefits, incorporating them into your ROI calculations. This strategic approach can enhance your overall return on investments. All right, let's move on over to the whiteboard session. Okay, to provide a practical understanding, let's look at a few case studies and real-world examples. Consider a property in Oahu purchased for $500 with an estimated annual rental income of $40K, with pretty much the operating expenses, including property management fees, the maintenance, taxes, and insurance, totaling to about $20K. The NOI is $20,000, and the ROI is 4%. This might seem modest, but if your property appreciation by 5% annually, the long-term ROI improves significantly. And another example here that I got here for Dallas, property purchased for $300K generates an annual rental income of $30,000. Operating expenses $15,000, resulting in an NOI of $15,000 and an ROI of 5%, factoring potential appreciation and mortgage paydown. The long-term ROI can be much higher, making a lucrative investment. Even without full documentation, you can accurately estimate the ROI on a rental property by leveraging your market data and estimating your expenses. This approach ensures you're making pretty much that informed decision and maximizing your investment potential. Before you go, make sure you check out our previous video, Investing in Residential Real Estate, How to Get the Best Deals, where we dive deep into finding and securing the most profitable properties. And don't forget to like, subscribe, and hit the bell icon so you never miss another insight video from us. See you next time.